All right, let's talk about Reddit. This is a wild one. We're talking about a company that not too long ago was losing money hand over fist when it went public. Now, it's one of the hottest stocks out there. So, what in the world happened? And, the big question is, did we miss the boat? Let's dive into what the pros are saying.
Okay, so just to put this into perspective, let's start with the raw numbers. When Reddit IPO'd back in March 2024, it was priced at $34 a share. Fast forward to November 2025, and it's trading at over $187. I mean, that is a jaw-dropping run-up. We're talking about a gain of more than 450% in about a year and a half. This incredible surge is really at the heart of everything we're going to talk about. So yeah, it's been a crazy ride. And that brings us to the million-dollar question, right? Is this stock a super risky bet now? I mean, has all the good news already been priced in? Or is this just the beginning? Could this be one of those huge growth stories that we're just seeing the start of? To really figure that out, we've got to pop the hood and see what's going on with the business itself.
Right. So, from loss to profit, this is the great turnaround. And this whole story really starts with an incredible transformation in the business. This isn't just hype driving the stock price up. Something fundamental has changed at Reddit. So, how did they do it?
It's kind of hard to believe now, but when Reddit had its IPO, it was losing money. A lot of it. In fact, right out of the gate, its earnings per share was negative $3.52. Basically, for every share out there, the company was in the red, partly because of all those IPO expenses. That's where the story began.
But then, everything changed. Just look at this timeline. After that first negative quarter, by Q3 of 2024, boom, they hit their first ever profitable quarter. And get this, it wasn't just a one-off. The profits kept growing and growing all the way up to 80 cents a share by the third quarter of 2025. This is like a textbook turnaround story, but it's happening at lightning speed.
So what's fueling all this? Well, it's just pure explosive growth. We're talking 68% revenue growth year over year. But here's the really important part. It's not just that they're bringing in more cash. They're actually keeping more of it. That 28% net margin, that means for every single dollar that comes in, 28 cents drops straight to the bottom line as pure profit. Wow. I mean, that's the sign of a seriously healthy operation.
All right, so the business itself is humming along beautifully. But this brings us to the big, looming question for anyone thinking about investing. What about the price? Is this thing just way too expensive? Let's try to unpack that valuation.
And to do that, we're going to look at a really common metric called the PE ratio, or price to earnings. Honestly, the easiest way to think about it is like a price tag for a stock. It tells you how much you're paying for each dollar of the company's profit. So yeah, a higher PE usually means you're looking at a more expensive stock, relatively speaking.
And whoa, this is where things get really interesting. Reddit's PE is sitting at a whopping 103. Now compare that to the average tech stock, which is around 41, or the entire S&P 500 at about 31. So Reddit isn't just a little expensive, it's playing in a completely different league. We're talking nosebleed level valuation here. So the big question is, why on earth would anyone pay that kind of premium? Well, according to the analysis, it's not just one thing. It's a whole cocktail of reasons. You've got that insane earnings growth, right? The massive revenue growth. You have a huge, dominant user base, over 116 million people every day. Plus that super important flip to being profitable. And then there's this, a 91% gross margin. That means for every dollar they make, they keep 91 cents before their main operating costs. So you see, people aren't paying for what Reddit is today, they're paying for what they think it's gonna be tomorrow. It's all a big bet on future growth.
Okay, so the story is compelling, for sure. But a pro investor never just buys the story. They need confirmation. They have a checklist. So let's go through that professional's checklist and see what else they're looking at.
So here are the signals they're looking for. It's really a three-step process. First, they analyze the momentum. Is the stock price trending up or down? Second, they check out what the expert ratings are saying. And third, maybe the most important, they follow the insiders, or the people who run the company buying or selling.
Now, when we look at momentum, this is where it gets pretty cool. The long-term picture, we're talking 24 weeks, is still super strong, up 65%. But if you zoom in on just the last 4 weeks, it's actually pulled back a bit, down almost 12%. Now to a pro, this isn't necessarily a bad thing. They see this as the stock just taking a breather. It's consolidating, which can actually be a really good time for a long-term investor to think about getting in.
Okay, next up,
expert ratings. And here, Reddit scores a Zacks rank #1, which is their top strong buy rating. And you got to understand, this isn't just some analyst's gut feeling. This rating is driven by data, specifically the fact that all the different analysts who cover the stock keep raising their earnings estimates. They keep saying, nope, we were too low, we think Reddit's going to make even more money. And when all the experts are getting more and more optimistic, that is a very, very powerful signal.
And last but not least, let's follow the insiders. To me, this is huge. A director at the company, David Hobiger, went out and bought over $200,000 worth of Reddit stock with his own cash. This wasn't a bonus or stock options. He wrote a check. When someone who has a front-row seat to the business is willing to put their own skin in the game like that, well, that speaks volumes. It's the ultimate vote of confidence.
So, okay, the business looks solid, the confirmation signals are there, so what's the game plan? How does an investor actually play this, knowing that there are big potential rewards but also some pretty big risks?
Well, the strategy here is definitely not go all in tomorrow. No way. It's all about being patient. The idea is to build your position slowly, over maybe 3 to 6 months. You'd be looking to buy in that 180 to 195 range, and especially trying to buy when the stock has a down day. And here's a pro tip. You want to see big trading volume on the days the stock goes up. That's your clue that the big players, the giant investment funds, are getting in on the action too.
But of course, there are no guarantees, right? You have to weigh the good against the bad. On the plus side, you've got things like their margins getting even better, or a big boost from AI and ad revenue. But the risks? Oh, they're real. The #1 risk is that sky-high valuation. The stock could fall hard, not because the business is bad, but just because investors decide they're not willing to pay such a high price anymore. And of course, you've always got to worry about user growth slowing down or new competition.
So, when you put it all together, here's the final take from the analyst. That combination of strong long-term momentum with this short-term pullback, that's a classic setup. But, and this is a big but, it's a setup for a very specific kind of investor. This is for someone who has patience and who can stomach the wild swings that are pretty much guaranteed with a stock like this. It's not for the faint of heart.
And all of this leaves us with one massive lingering question. Is what we're seeing with Reddit a brand new playbook for how tech companies can become profitable? Or is this just a classic story of the market getting way, way ahead of itself? Honestly, the story is still being written. The next chapter is going to be fascinating to watch. Thanks for digging into this with me.